but you can't really run a venture business on that because there's kind of a minimum valuations that just make sense for collecting venture capital.
1, 2, 3.
Coming up, we're talking ag investing with Clay Mitchell, the co-founder and managing director of Farmland Capital, who has both a venture capital arm and a farmland arm. The Modern Acre podcast is presented by Myland, a soil health company that's revolutionizing agriculture. Through their innovative soil as a service, Myland partners with farmers to improve their soil health with the power of beneficial live native microalgae. The result? Healthier soils, more productive farms, and benefits like smarter water use. Discover how Myland can transform your farm at myland.ag.
Ty, are you ready? You look a little bit tired. We're gearing up for event season. This week is our first in-person event that we're doing this year, World Ag Expo. Are you ready?
Oh man, I was born. I was truly born and bred for World Ag Expo, but have never been.
Can't wait to get you out there, Ty, get some boots on, start chatting with growers, talking to companies. It's going to be good for you.
It's going to be really good for me. I'm dusting off the Red Wings and excited to be there. So yeah, a great first event of the year. I'm really excited to see it. And anyone who's listening that's going to be at World Ag Expo, come say hi to us. So my company, Polaris Energy Services, is going to have a booth at the PG&E Pavilion, which sounds really exciting, Tim, the PG&E Pavilion. It's at the entrance to Gate B. So when you come in, just come in Gate B. B is for best. And come say hi. Tim and I will be there, some folks from our team for Polaris Energy Services, talking about our new program with PG&E called Hourly Flex Pricing, where customers can save money on their bill. They can get incentives for automation. We'll just talk your ear off about all the great things that Polaris offers to growers.
Ty, the big decision I have is what hat to wear. You know, it's always a conflict when you go to these things. There's only one hat you can wear to these things. I don't know what to do.
Yeah, you could wear your Nuss Farms hat. You could wear your Polaris hat. But Tim, you know what I think? Which hat you should wear? I think it's the farmer mode hat.
Ooh, the farmer mode hat. Good call, Ty.
How did you not think of that?
I know. I got to dust that one off. It's going to be ready to go for tomorrow.
All right, so you guys gotta see if you can spot Tim. It's like, where's Waldo? Where's the farmer mode hat? So that is going to be cool to see. But yeah, would love to connect with anyone, any of our listeners. Come on by the PG&E Pavilion, and we'll be at the Polaris Energy Services booth. Tim, speaking of events, there's another event that we always have marked on our calendar, and that's World AgTech in San Francisco.
Super excited for this one next month in San Francisco. We've been to it the past couple years. Always have a really good time. It's like the Super Bowl of AgTech investing. There's just so many cool people to chat with there. Awesome networking. So excited to be back. Our guest on today's episode, Clay Mitchell from Farmland Capital, is going to be speaking at the event as well. So it was fun chatting with him to catch up before the conference.
Yeah, so if you guys are going to be at AgTech, let us know. We'll be there as well. There's all these World Ag. It's confusing. But World Ag Expo will be there this week. World AgTech will be there next month in San Francisco, along with Clay. Tim, it was great chatting with Clay. I think they built Farmland over a decade ago, right? Like they've been in the game for a long time, in farmland, in venture capital, in AgTech. So much experience there and knowledge in the space. We get into like structures, having both farmland and VC arms, and why that's a benefit, but maybe why that's a challenge as well. So a ton in here about what they're focused on, what they're excited about. You guys are going to love this one with Clay. Let's jump in with what's top of mind.
Very recently, we're coming off a week where the impact of DeepSeek has kind of hit the markets, and people are trying to figure out what that means, which, I think extending the trends that we've already seen with AI, which is, accelerating the adoption of proprietary technology, commoditization of data, and a lot of just raw IP, and putting more emphasis on delivering services, delivering products. I think this has been a theme in our business for a long time because we run both a venture practice, and a farmland practice. So we work in a field where proprietary know-how and IP has traditionally been, the anchor around which enterprise value is built. We live in a world where it's just not safe for very long. The shelf life is incredibly short, but we're also anchored in commodity farming businesses where execution is everything. And so, I think we've always had a perspective that operating discipline is incredibly important. I think that's what's being highlighted this week.
Yeah, it seems like DeepSeek came out of nowhere. I just saw it all over my Twitter feed, what was happening there. Like the cost that it took them to get to that stage was quite a bit below the other leaders in the space, and sort of like really interesting what this means for venture-backed businesses, where historically like there was a moat in building a software business. You needed heavy engineering, and now you can essentially clone a company using AI and kind of get there very quickly by being able to replicate it. So really curious to get into kind of the venture side in ag tech and like what that means for ag tech companies in the space with the emergence of AI. But before we jump into all that, Clay, I want to get into structure and everything with Fall Line Cap. Let's learn a little bit more about you and your background and what led you into agriculture.
Yeah, I grew up on a family farm in Iowa, a very typical Midwestern farm, has been in the family for 5 generations. And I just had a wonderful childhood where I enjoyed, working with my dad. He's an engineer, and I enjoyed building things. And from an early age started really having a big curiosity about where there are opportunities to improve productivity on my farm. And I also noticed that the quality of our topsoil, the depth of our topsoil was really important for the productivity of our farms. And that, I could see that getting lost over time and could see that it was rebuilt over, much slower time frames. So I also had a really strong attraction and commitment to conservation from an early age. I studied engineering in college, and that really built out a skill set to be able to use a lot of engineering tools to solve the problems that I was seeing on the farm. And it was during a time when a lot of great technologies emerging in other industries were available in agriculture, and I could bring new controllers and compute into solving problems that I had on my farm. One of the things that I did every year was go on a ski trip with my ski team buddies, including Eric O'Brien, who is my business partner, and went down a very different path of going into venture capital. He was at Lightspeed, and I'd be enthralled by his stories of life in Silicon Valley. He would hear about the innovations I was doing on the farm. In 2011, we decided to combine our backgrounds and invest in both farmland and early stage ag technologies. So I brought an understanding of how the dynamics of soil production work, and he brought an understanding of how the dynamics of capital works, and it's been incredibly fruitful.
All right, so let's dig into, you have this awesome background, you have this engineering background, you've focused on ag tech, you've explored it, you've done it on your farm, you wanted to put together this, you want to invest in it now, both in the technology side and the farmland side. You bring on a partner. Talk us through like the early days and the decisions you made up front of, how you want to structure this, how you want to go to market. Walk us through that a little bit.
Yeah, we wanted to come out of something that was fairly familiar and vanilla, so we could get an LP base. And Eric had a lot of good connections, was respected by a lot of strong LPs. We started with a 10-year fund that was 95% farmland and 5% venture. So it was just the venture in the early days was a chance to invest in a few technologies here and there that we thought would really play well into the farmland strategy. But it was working so well that expanded to 10, 15, 20, 30%, and is now about 50% of our business. We were able to get, a good, strong LP base of family offices and universities from the beginning. And that's continued to be able to supply our business with reliable capital.
Let's dig into the farmland side a little bit. Maybe talk to us about kind of the management approach. Are you managing the farms yourself? Are you leasing this out or working with farm management companies? And where's the portfolio sit, crop mix?
Yeah, it's very hands-on. We work with tenant farmers, but we do all the management. We work hand in hand when we're doing land developments. Our team is there, in person. We're writing the construction inspection protocols. We're getting our hands right in it, advising farmers on agronomy. And that goes back to the beginning of when we do acquisitions. Everybody on our team has pulled soil samples. We've never bought a farm without pulling soil samples ourselves. So it's really making our own judgments about one of the things that's interesting about the state of Iowa is it's the place that I think farmland is traded the most based on kind of the historical soil qualities, not current soil quality. So I don't know if you guys know this. Have you ever heard of the CSR index? Okay, so it's a score between 5 and 100 that's based on what the historical soil type is that may have been pulled a generation or two ago, and it was built for tax purposes. That it was important to be able to value farmland and something that was stable and wasn't a function of the efficiency, the productivity of the individual farmer. This, if it were based off the yield, then it would reward bad farmers and punish good farmers. But an unintended consequence of that system is that it's kind of become the de facto way of valuing farmland. And so if something's a 95 CSR farm, even if somebody destroys the topsoil, it's still a 95 CSR farm. And if somebody does a great job of caring for another farm that may be 70 CSR and slowly building up over generations, it doesn't gain in value. And there's a clear inefficiency there. There are similar systems in a lot of other states, productivity indices, and you just don't see any other physical asset traded based on the condition it was a generation or two ago. You wouldn't buy a house based on the condition it was in the 1950s, or a classic car based on how it came out of the factory.
Was that a strategy of yours?
It was one, very much of, that we could, take an inventory of what was actually there, do a better job of underwriting the soil. And then as we expanded the footprint, it's also, I think to a similar degree, we see a lot of farms traded where the infrastructure, water rights, and other things that are key to the value are not really, really well understood. And so it's doing a better job of underwriting to begin with to get undervalued assets. And then, having a strong thesis about something that we're doing transformative on the farm. So, we never have bought a farm and just, considered it something with kind of a static production system. We either want to have a thesis around how we can really improve the agronomy of the farm or improve the infrastructure of the farm to make it more productive.
Clay, in terms of farmland, what geography are you guys focused on? Any particular geographies? How have you thought about acquisition as it relates to location?
Yeah, we're always looking all over the U.S. So we're currently all U.S. based, even though everybody on the team has international experience as well. We purchased farmland in areas with very different conditions: 60 inches of rainfall, 6 inches of rainfall, heavy clays, silty loams, beach sand. Louisiana, Arkansas, Mississippi, Tennessee, Kentucky, Montana, Idaho, Washington, Oregon, California. So very different conditions, mostly a row crop focus. So, I think on the AgTech side, there are a lot of folks who see labor as, one of the biggest resource limitations in farming. And, I think that's a very different story in California and the Pacific Northwest in higher value crops, where labor is a percentage of the budget is basically 10 times higher than it is in the major row crops. So it's really efficiency around the natural resources is the thrust across most of our farmland.
Clay, you talked a little bit about kind of the value add, kind of bringing in something unique on the agronomy side to make the soil more productive, adding infrastructure like in kind of the row crop systems where it is kind of commodity markets. Like, have you looked upstream into like processing, distribution to kind of extract value there, or do you kind of end at the farm gate?
No, it's typically at the farm gate. So we don't do vertical integration at this point in our business. It's a pretty clear investment in the farmland itself and making it more productive.
Clay, I want to get into some of the structures around this because I find it really, really interesting, this thesis of farmland piece and kind of AgTech venture piece because of the synergies between those things. How have you thought about, do you keep those distinct and separate? Because I imagine when it comes to LPs, you have LPs that are like, we want to invest in farmland. And then you have LPs of, we want to invest in venture. How have you thought about kind of separating or bringing those together, and how the fund has evolved over the years?
That's a great question. Our first funds combined the assets. So it was farmland and venture were both in the same fund. So anybody who invested had the ratio that we deployed into. And we had investors who wanted to invest in, one more than the other. They wanted a different ratio. So the last funds that we've raised have been dedicated to farmland and dedicated venture, but the majority of our capital is from investors who invest in both. They're able to dial in, the ratio that suits their appetite.
Let's dig into the venture side a little bit. You have a pretty impressive portfolio. We've talked to a number of these companies on the podcast before, but maybe just talk to us about the thesis. Like there's some like bonsai that are more specialty crops doing almond work, and most of the farmland is in row crops. So maybe talk to us about kind of the thesis there, because you're making investments that don't necessarily have like an angle for your farmland investments.
I think with the example of bonsai, I know you've talked to Tyler on the show, and we're just thrilled with the way that he's kicked off in tree nuts, and the initial focus is tree nuts, but the ability that they have built within the team to bring automation into machines where the OEMs they're working with don't have that ability to do it themselves, going beyond just the proprietary tech that they're bringing, but really understanding how can we rethink the machine, how can we reimagine the operations that we're doing with kind of an automation first, autonomy first view is a very portable skill that they're building. So it's important for us not to invest in areas that are kind of niche-y areas within ag. You see in our portfolio a lot of deep tech that serves areas outside of, just canonical ag. So, Planet Labs in our portfolio wouldn't call themselves an ag company, but, agriculture is clearly very important to them. Swift Navigation, again, not an ag company, but ag is an important market for them. Same with our Zeta, which is a synbio company that creates novel proteins and enzymes, specialty chems. They serve a lot of different industries. Crop protection, food, is included within that. I think it's very challenging within ag to run a venture business that has, serves very, very, very strictly the ag vertical and would only invest in like canonically ag tech, because so many of the great startups in ag have exit potential. It's 20 or 30 or 40 or $50 million. And it's great if somebody bootstraps a company, is able to create some good cash flows, eventually sell a business for that. They're doing great. That's a fantastic outcome. And there's a lot of opportunity meeting very specific kind of niche opportunities in ag. But you can't really run a venture business on that, because there's kind of a minimum valuations that just make sense for collecting venture capital. People running those businesses should collect money from friends. You can't really, run a professional firm trying to scale down the entire capitalization, ratios to something that accommodates that. So we're going after the biggest problems in agriculture, companies that are that we think can solve those, as well as deep tech companies that are also serving, automotive or human health or other areas.
Clay, you've been doing this for a long time. You were early to kind of, I think, a lot of buzz around ag tech and farmland investing is, sexy now. What have you learned? Like what has worked really well for you guys in terms of your investment strategy, and maybe what's maybe not worked?
I think an interesting perspective we've had being in both farmland and venture throughout our history, they have been completely out of phase in the cycle, where they have been in the cycles. When the public was enthusiastic about farmland and farmland economics were on the rise, was not the best time in venture. And then as farmland was going through tough times, it was during a boom time for venture. And so it really gave, a lot of patience, where we'd see folks working within just, a particular asset class, and that's the world that they know, start to question, the laws of economics, the laws of physics, and how they work within their space when you're kind of caught up in a trend. And having a foot in both has helped us gain a perspective to see, where is their long-term value? Where can we be investing in companies that are on, the right side of very inevitable trends in farming?
Clay, what areas of venture and ag tech are getting you most excited right now? I'm sure you are getting a lot of pitches for companies trying to start new ideas. Like, what are you really kind of excited about in 2025?
We invest across, materials, automation, AI, some downstream of the farm, some foods, climate. And so there are quite a few areas that we're excited about. And we, develop theses in each of these areas very deliberately. But a couple of things that have been the most exciting for me are heavy lift drones for spraying, highly selective chemistry for crop protection like RNAi. We're investors in Guardian, and the concept there has been like a kind of cartoon idea that every farmer's dreamed about. I can remember many decades ago seeing, people draw pictures of farm machinery that would hover above the ground. It's just been the dream to be able to avoid the soil damage, crop damage, and apply inputs that way. And the technology to do that is here now in a really scalable, cost-effective way. Initially, we were excited about developing a drone from the ground up to be really accurate because we've got land in the Mississippi Delta where chemicals are applied by airplane, and we see the damaging effects of the drift. And so it was initially kind of specialized cases that got us excited, but then we quickly realized that this was going to win on OpEx and CapEx. You don't see that yet with the very small machines that entered the market first. They just don't have the productivity to serve large areas. But with the large machines being developed now, it certainly does. So that's a super exciting area.
Yeah, I agree with you. That one is highly important, and every farmer uses that, and it's getting harder and harder. Like just on our farm, finding aerial applicators, whether it's helicopter or fixed wing aircraft, like it's just kind of an old dying business where the pilots are retiring, and it's just getting harder and harder to get those jobs done. I was at FIRA last fall and saw the Guardian machine, so it's been cool to see that in person, and seems like they're a couple of years out with their kind of commercialization. Like obviously they have some investment with Wilbur Ellis as well, kind of focusing there to offer as a service in select markets. But I think a huge opportunity in years to come because it's just something that is universally needed in agriculture.
Mm-hmm. I mentioned RNAi as well. And, it was just such distinct childhood memories of spraying non-selective insecticides and going out and then seeing, it's kind of like Silent Spring. Everything's dead. You've killed the spiders and the flies and the butterflies and the ladybugs and everything. And then you would notice that when the beneficials are gone, you can get a flood of anything coming back in. Really, you could observe the destabilizing effect of that. But yet, insecticides are incredibly important, aspect of crop protection. So the dream of having something that would be completely selective has been around for a long time. And, this last year was the first year ever that something based on RNAi has been on the market. And Calantha, serving potato farmers with Colorado potato beetle activity, has been the initial product. And the farmers have been just completely overjoyed with it, to be able to go in the field and see that you've only killed the target pest and everything else is completely unaffected is, until we've been involved in the company for a long time. So we've done trials and I helped design the trials that the company did, but to actually see it work at commercial scale is like a dream come true.
Clay, want to get into just the state of AgTech. I think there's a lot of macroeconomic headwinds. There's potentially some regulatory tailwinds with the new administration. Like, how are you thinking about the state of AgTech? And as a venture capital investor, like what exits look like? What's your kind of general perception of the market right now?
I mean, I think the market is not very good right now. But I think the important perspective to have, I think there are folks who haven't really popped their heads up to have a grip on the macro. And so they're talking themselves into kind of absurd existentialist questions on whether capital works in this marketplace or not. I mean, you've got $4 trillion of farm gate value created in the ag economy. This is a huge portion of the economy. Capital works in this market like everything else. Since, the heydays of 2020, 21, the downturn that we've seen in 2022 is like venture wide. I mean, it's and the whole economy has been affected by debt becoming more expensive, by the increased cost of capital, and the discounts to long-term cash flows that come from that. It's affected, all kinds of different markets. So, so much of what people are experiencing at this moment in ag tech is not particular to ag tech. But I do also think that you have had during the heyday, a lot of venture investment go into a lot of these businesses I was describing earlier that are, could have 20, 30, 40, $50 million, outcomes that are, great businesses, but shouldn't be backed by venture. And so it's really finding the right capital for the right enterprise is the key thing.
Clay, what do you think happens to some of these companies that, like you said, like they might be $20, $30 million business that serves a really good niche, is profitable, but is never going to reach that kind of like venture scale? Like what happens to those companies? Is there any kind of like alternate exit strategy for them?
Well, I mean, I think the key word you said there is profitable. I mean, if a company's got good cash flows serving a market, then they don't necessarily need additional capital going forward, and that's fine. I think a lot of these businesses that maybe could have been better businesses if the founders had other sources of capital, maybe weren't built as good as they could have been when the cash that was the easiest to get is the venture capital and the next round of venture capital and the next round of venture capital and the next round of venture capital, so that the focus was less on the customer and more on the venture capitalists. And I think it's a huge problem in any startup if the focus becomes too much on fundraising. Like it is not just a distraction to serving a customer, but I think a completely opposed way of thinking. When somebody's pitching to a venture capitalist, you want to tell a story of a big TAM. You want to tell a story of like things that can go right. And it's about the big picture. It's about, dreaming and trying to get the greed juices flowing. And in serving a farmer, it's about every little detail that can go wrong. It's about having, outstanding discipline in the management of the organization and cash efficiency. And those are just two very different ways of thinking. I don't think a CEO goes back and forth between those really smoothly. And so the more they can focus on running the business, the less they can focus on raising capital, the better the business is going to be.
And I think we're just seeing that change in the market, both in terms of like founders that are being, I think, a bit more thoughtful of raising venture capital at all or not, right? Not just doing it because that's what you're supposed to do, but really saying, hey, do we need venture capital to make the business a success? And then similarly, even if and when you do raise venture capital, having more thoughtful approach to being cash generative.
No, Tyler, I agree 100%.
Clay, as we kind of wrap up here, I'm curious your opinion. What's your food or ag hot take?
My hot take is that most companies in ag tech that fail because the products don't work, and this is not why the boards think they fail. Generally, the boards are led to believe that the products work, and it's because of marketing and sales and other factors. And true story, there was an investor and board member of a highly capitalized ag startup who was asked, how does this product work? And his answer was, I don't know, and I don't want to know. And who it was and what company is not important, because this is an attitude that I think is pretty common among venture investors who simply, some don't know and they don't want to know. More commonly, it's just very difficult to know. I think as a board member, if a product actually works, I think we've got a huge advantage in being able to try products on our farms, of having a very technical team of engineers and scientists who have often tried to solve the same kind of problems that our companies are trying to solve.
No, I think that gives you such a unique advantage, being able to like vet and diligence companies that you're talking to from a VC investment perspective to like really translate, like, would this actually work on our farmland, and like talk to your farm managers of like, does this idea make sense, and kind of bounce ideas like in the real world versus hypotheticals.
Yeah. And so it's something that we look for in our companies is not just a management team that's capable of delivering a great product, but great syndicate partners who don't have that attitude, who really do want to know and who have the capability of knowing, and we've got a lot of really great boards in our portfolio.
Well, Clay, as we wrap up, how can listeners get in touch and connect with you and Farmland Capital?
Yeah, you can find Fall Line at www.fall-line-cap.com.
So, Ty, what do you think of the conversation with Clay?
Yeah, it was great to hear. And like I said at the top, I think it's great to hear from a seasoned veteran. Okay, I'm not calling Clay old, but it's cool to talk to someone who's kind of been around the block and through a few cycles, right? Like I think that people newer to this space we're experiencing a downturn in AgTech investing. If you've been around a long time, you just know that this happens, right? And there's cycles, and just having a level set of what that means and how that actually makes you more disciplined. And I think he spoke about his discipline over the years, because he knows you should look at AgTech and farmland investing through the lens of, hey, it's cyclical. And knowing markets are going to go up and down, like you need to have that as part of your kind of diligencing, that you got to plan for things to not be as rosy or always good times. So I think that was really insightful.
Totally. Well, if you guys are at World Ag Expo this week, try to find Tyler and I. I'll be wearing the farmer mode hat. Or if you're at World AgriTech next month, we'll be in San Francisco and we'll see you there.